Nandan Chakraborty now joins in from Axis Capital, from the sidelines of the Rising Stars conference. Hi Nandan, good morning. First up, what's your opinion on the gas price status quo and how the markets read that, and how will global investors react to this news?
So you remember the story of Ramayana? You know what Sita had to undergo? So Modi is coming in at a time when not only he has to do things right, but he has to be seen to be doing things right. So he has to be seen that he's addressing all the issues. He's not being partial to any section of society. So that's one part of it. And second, just like this rail hike and the other things, because the government coffers are empty, he has to see that whatever he does for one industry to be able to invite more investment into this industry doesn't give a very sharp shock to any input industry, which then obviously gets affected. It's not just a question of populism or vote bank. It's a question of input costs suddenly rising on all directions. You can't have fertilizers and this and that sort of rising. So it's a question of short term versus long term. In the short term, inflation, there are inflationary pressures and they have to be taken in small doses. Unfortunately, the government coffers are so empty that you can't do too much in small doses. At the same time, he has to do long term things, which if he doesn't do this, unfortunately what will happen is, there will be no new investment coming in. Because obviously, below $8, $9, you can't have new investments coming in. So he has to be seen to be taking a good look at things, and it should not be that every committee report that comes to him, if he doesn't like it, then he asks for another committee. That is a thing which used to happen in previous governments. So he has to see that he makes a decision in reasonable time and not reject commission decisions till he gets the one that he likes.
Okay, so, but having said that, do you think now a delay is inevitable in any case, maybe even beyond 3 months, and is there a risk to this entire segment?
In my mind, and we follow logic, in my mind, I don't think there's any chance of gas price hike not being there at all, because ultimately there is two things. One is what is contractual, okay? And this is going into a lot of issues, but firstly, what is contractual? Secondly, then it will become unviable. What is the point? You can't keep beating a dead donkey. So you will not be able to invite any new investments into the sector, and this is a massive potential, this whole sector, and this is something that's required for us. It's only a question of juggling around, and maybe some of the very high parts of the basket, like Japan or something, may be reduced. So you might, sort of tinker around it so that the basket which that you take is more reasonable.
Okay. Given that the price hike is deferred for 3 months, so what's your take on the oil and gas space now? I mean, within the upstream and the downstream companies, what are the companies that you like the most?
Actually, we like mainly the upstream companies, which is RIL and ONGC. On the downstream companies, we are not so constructive at this point in time.
We are now heading into, the first budget of the new government, and there's so much hype about that. Given that there was a rail hike and the gas price hike got deferred, there are a lot of expectations from this one. What are the things that you will be watching out for the most in this budget?
See, I'll have to give a slightly elongated answer because there are 4 or 5 different points. One is the fact that from the market point of view, people are not likely to sell before the budget because it's a completely new event, new government, so they'd rather, even if people want to do some profit taking, and this is leaving alone things like oil and Iraq and, things abroad where, of course, anything can happen. But generally, if anybody wants to profit take, they will wait till the budget because they want to see what's happening. Number 2, the budget, well, he's already said and he's already prepared us mentally that it's going to be, certain bitter tasting medicines. But saying something on TV which reaches the intelligentsia and saying something to people who don't have jobs is something completely different, because the people who don't have jobs don't care what you say and how much you mentally prepare them for inflation or whatever. So I think one of the most important things of this government is going to be what it can do for job growth. Because on the one hand, there's been people like us, the so-called intelligentsia and so on, who basically we will give him a year, and this will be the year to set policies and to basically say that Mr. Modi is setting policies which are just and long term. But for people, there's an equally large number, maybe much larger number of people who have basically had jobless growth for the last so many years. So they have now got fed up and they voted for Modi because they expect job growth. So, industries, sectors which employ a lot of people, like construction, let's say textiles, let's say the SME industry, chemicals, small machinery parts, industrial inputs and so on. I think maybe there will be some sops given to these industries in the budget. And while I'm not necessarily looking forward to these or whatever, something has to be done for job growth, because that huge part of the country is not going to wait for justice and good laws and so on and so forth that we are waiting for.
Okay. We know you've been bullish on NBFCs and the private sector banks, but apart from banks, what's your view on the auto sector, Nandan? That's where we've seen a big outperformance in the recent past.
See, it is obvious that the biggest kicker has to come from commercial vehicles. I mean, that's a no-brainer. Question is, will it come right now? Will it come a year later? Difficult to compute the timing, but the biggest kicker has to come in commercial vehicles, because that's industrial growth. As far as cars and two-wheelers are concerned, I think a lot of the urban side is getting more and more into replacement demand. So I think one has to go a little more, both in banking as well as in auto, a little more distribution to get more and more customers, to have the same sort of growth rates that we've had in the previous decade.
Okay, so Nandan, the sector that's seen a lot of attention from government is power sector. Even yesterday we had the interview with the minister. Given that there's some recovery in capital markets, do you think there's some scope for outperformance in power stocks in next 6 to 8 months?
6 to 8 months be a difficult call to take, but definitely over the next 12 months there should be, because a lot of things still have to come in place. So what you will see is power companies trying to, at least the assets which are not stranded. So one part is the unstranded assets. They will get better financing and they will be bought and sold, so there will be a lot of mergers and acquisitions and so on. The ones which are stranded, we'll have to wait. That's largely in the gas sector. So we'll have to wait a little while and see what happens to that.
Okay, Nandan, we're taking a query from Money Control Board. Uma Shankar writes to us from New Delhi, and she wants to know your general view on the defensives. Is it good time to get out of that space?
See, without being too specific about numbers, generally a market cycle is a 1:5 thing. 1 year of fantastic markets, 5 years of slightly stabler markets. So if you don't make outstanding returns in that 1 year, then what happens is more and more difficult to make up for it. So what happens, why people get out of defensives in this phase, is that it's not that defensives will not make you money. It will still make you that 15%, 20% money. But then, and it's not greed. It's like if you're, everybody, makes some losses, some gains in their trades. So you need some, if not multi-baggers, at least doublers, very high, 60-70% return in some stocks to make up for the other duds. So you can't have a fully defensive portfolio, especially in a year which is, is one of those 1:5. So I think that's the overall context. Now within that, defensives is basically, one is FMCG, where I still feel that things are expensive, but on the other hand, they have very unique characteristics, like HUL, for example. If the buybacks keep coming, the price will not fall and it will keep becoming expensive. ITC is the only company which has nothing to do with oil prices, palm oil or anything. I mean, very, very little to do with all that. So, irrespective of what happens in excise duties and things like that, ITC is unlike any other FMCG company. So, it's very biased towards that. These sort of specific criteria. So ITC, our company is, still bullish on it, or rather in a hold sort of position. HUL, we have a sell because of the valuations, and we may go wrong because of the buybacks that will continue to happen. And the smaller companies, except for very small companies, I think they're fairly valued. But the other ones are, one is the export side, which is pharma and IT, and then there are those companies which have such good business models that they continue to grow. Some of the, banks and things like that. So, I think the first part what I addressed why people get out of these is these types, which are these, banks and there's some large banks which have a continuous model of growth. People get out of them because, you need 1 year of, very good returns. So you would rather take the higher beta banks than those. As far as IT and pharma are concerned, see what happens in pharma and IT also is, they've been in a defensive market for the last so many years. In pharma, which is a very peculiar thing, is because there is a portfolio of products and you don't know which will come out when, you always underestimate the EPS growth. So you always get surprised on whether it will do well or badly. So generally for a well-managed pharma company, it is better to simply wait when nothing's happening. Buy when nothing's happening if you know that their portfolio is strong. Because you don't know when something may be launched. And the companies that we have which are already there in our strategy reports, the well-known companies, which I think that is the specific stock-specific strategy in pharma. In IT now, a very peculiar thing has happened, is because of this whole business of people expecting the INR to appreciate. People think that IT will sort of close in their business expansion. And that over the next 3-4 years also the business expansion will be closed in. Now, I don't believe that we are in a phase where for the next 5 years will be the same thing like 2004 to 2009 where the rupee appreciated. That was too many factors. It is not just India related. There's too many great factors that was there in our lifetime. So I think we will have a modest depreciation of the rupee, not as severe it was at earlier, and therefore people will revise all their earnings towards IT and so on. And I think one will get into IT at the right time. But as I mentioned, my main caveat was that 1 year you have to make up for 5 years.
All right, we've seen a lot of interesting names in the Rising Star Conference, Nandan. From a strategy perspective, which are the mid-cap companies that you like, something that can become multi-baggers going forward?
We would have invited only companies that we like. We wouldn't like to, difficult to associate oneself with companies that you don't like. So we have a huge list of companies. Actually, it's so lovely doing business at these times because any company wants to come. Clients, there's too much of demand. Whereas the same thing, let's say 5 months back, you struggle to get clients and corporates to meet. So we have, Camson Biotech, which is a very interesting model of organic farming. Okay. Then we have CARE, I think this is very well known. Then you have Phenolics Industries, which is what I talked about, industrial inputs. And there's a capex play going in there also. Cox & Kings is very well known for, its travel. But more important, there's a massive deleveraging story in Cox & Kings. Then Dalmia Bharat is obviously, it's an infrastructure input. Then you have Jain Irrigation, where, subject to monsoons and all that, I think the government will have to increase its subsidy because drip irrigation obviously is very important for India. And there again, there is some deleveraging going on there. Then Lakshmi Vilas Bank, as I mentioned, not only is it cheap, but it's in the right space. Maharashtra Seamless is an interesting case of, again, inputs for the oil industry. So I think that's that's one of the growing areas of India. Then Mahindra Lifespace is a well-known company, of course. Ratnamani Metals and Tubes, again, inputs into industry. City Cable Network, as the name, Religare Enterprises. These are well-known, so I'm not describing them. Then SREI Infrastructure Finance, well-known. Vaibhav Global is an interesting model. This is a model where a Rajasthan-based company actually makes money on an internet model to selling to US consumers. And this is an internet model which makes money. So I think which is not very common. So I think it's a very interesting model. And finally we have Vardhaman Textiles, which, textiles has multiple things going for it. Because of, the dip in the competition from China decreasing and things which are happening in India also. And as I said, hopefully there will be something good things in the budget. Let's see.
Yes, hopefully there will be. Nandan, thank you for talking about all those stocks, your mid-cap buys and what you're expecting from the budget this time around. Thanks for joining.